Hey everybody, today I will be going over Dell's earnings report, their preview, their latest earnings report. I'll go over their financials and then I'll look at their chart a little bit and kind of just see in general where the stock and the company's going. So make sure to subscribe and let's get into it. All right, so I think most people know what Dell is. They basically do computers, information technology, services, including those things. A lot of computer hardware, things like that. Anyway, let's get right through the financials and then we will get to the earnings report. So, cost of capital looks good, target price looks okay, long term growth looks solid at 11% right here. Let's go down to the income statement, see what we see. So it looks like sales actually took the estimate for 2024 will finalize around 91 billion, which is enormous. Dell is a massive company with a lot of reach, but looks like they maxed out around 2022 right after COVID and took a little bit of a dip since then. So overall, we'll have to see in the future if they start recovering from that. In terms of their operating income, though, you could see it really did not take a hit as much. And I'm actually just going to use instead of the estimate, I'm going to use the finalized reports. Operating income really did not take a hit, even when the sales went down. So that is actually excellent. That is very, very good. It usually signals towards very solid management. One thing I will say though is net income was down, but again with a lot of large sales growth. But it looks like it is better than it was in 2021, significantly better. So compared to 86 billion here and 88 billion here, there's a 1 billion increase. So basically a 50% increase in net income compared to like a maybe 3 or 4% increase in sales, which in my opinion is massive. So I will go with that. One thing that I will say, I believe I brought this up with HP as well when I reviewed them a couple days ago, but they had a massive amount of, might not have been HP, it might have been another company. But anyway, they had a lot of growth post-COVID where a lot of people were at home, they were working from home, they bought a lot of laptops and computers and things. And now that that massive demand is kind of dying off, and they're going back to like business as usual, it's a little bit back to normal. So you can see compared to 2021 and even 2020, where their sales really started kicking off, they are just about in line. And while that was happening, net income also increased. So I'm going to keep it at a 1 there. And then for EPS, again, big tick up in 2022, but overall it looks like we're just about in line with the EPS. For total shares, I did glance at their stuff earlier, and it does look like they have been buying down their shares a decent amount. So, I mean, you can see here, I never know. I guess I'll just do basic shares outstanding. You could see their basic shares outstanding have been going down a decent amount. I'm going to give them the credit there. Let's check out the balance sheet and see how everything is here. So cash compared to short term is mostly coverable. They have a lot of debt. One thing we'll see is that I'm going to put the 0.5 there because their cash is just barely covering their short term. Assets, though, it looks like they have been declining for a while. Maxed out in 2020. Actually, even since 2018, they have not seen a high in their assets, which honestly could be a good thing. I mean, their net income is increasing. They are selling off things they don't need. But overall, I would rather them be growing assets than losing assets. I mean, if you go from 120 to 80 in 4 years, that is like a 30% decrease or something. Something like that. Yeah, like a 30% decrease in 3 or 4 years, which is kind of a lot. That is a lot. Short-term debt is a lot. Their long-term doesn't look great either. However, if you look, they have been bringing it down way, way, way down. So I'm actually going to give them credit for the long term because that has been decreased massively from 49 billion down to 19 and a half, which still is a lot to be fair, but nowhere near what it was. Also, with retained earnings recently, you can see their retained earnings have been coming back up. So they're still negative, but they are increasing. So I'll do the 0.5 there because it does look like they will be going positive probably within a year or two, which is a really good sign for the overall kind of financial health of the company. So going into the cash flows, operations look really solid. They have kind of again went down from 2021, 2022, but it looks like funds from operations has been increasing. It's mostly just the changes in working capital, which is basically just looks like they brought on a lot of inventory. So that could be good. That could be a good thing. I wouldn't necessarily say that's bad. I'm going to do the 0.5 there because although the operating cash flow is going down, the funds from operations that you can see here is still consistent and has been going up for the past 2 years. Overall, for investing cash flow, again, capital expenditures looks like it's actually decreasing, which is good. You really don't want CapEx to be too high. And then other than that, sold some investments, not too bad. Looks pretty good there. Financing cash flow looks like, again, reduction of debt is great. Change in capital stock is great. Looks good there. And then their free cash flow is consistently positive. It looks like they're going to, again, this is estimates for the rest of the year, I believe, or something, but I'm not going to look at that at this exact moment. But overall, their free cash flow is down from where it used to be. 9 billion at one point, 7 billion at one point. But overall, it's sort of in line. So I think I'm going to give it again the 0.5. And use of cash. Let's see what we see. So interest expense is enormous. They're not repaying, which is not great. But again, they're paying off their interest at least, and they're not issuing more, which is really, really good. That is fantastic. So I'm going to do the 0.5 there because I'm not seeing repayments, but I'm also not seeing an issuance either. So overall, not bad. And then repurchasing looks really, really good. They have been repurchasing a lot, as we kind of highlighted earlier. Looks like they issued a ton of equity in 2017, but have since massively paid that off and then some. So that is all positives there. Let's check out the ratios. Hopefully we see some good improvements here, maybe a little above average action. And no, we do not. No, we do not. So their SG&A, which actually SG&A, sorry, never mind. SG&A to sales, you want to be lower. And it is below their 5-year average. Looks like it ticked up in the past year or so, which isn't too terrible just compared to where it used to be. It used to be much, much higher. So cutting those costs, pretty solid. Net margin is at 363, 371 is the average. Again, we saw that jump up in 2022. And before that, they were actually negative, which is kind of surprising. I thought Dell was a bit more of a matured cash cow kind of company, but it looks like they more in the past few years kind of turned it around. But 363 compared to the average of 371, I think so that is still solid for them, but just it being a little bit below the 5-year average, I'm going to do the 0.5 there. I don't think it really warrants the full credit there when they're still below average, and 3.63% is not that great of a net margin, to be completely honest. Not great. So ROA, ROE, their equity is negative. mostly because of, I believe, retained earnings, though, which is not terrible. But return on assets is slightly above the 5-year average. Looks fairly consistent with what they've been seeing. So that is good. And then their long-term debt to total equity, again, they have a ton of long-term debt, but compared to where it used to be, they used to have an enormous amount of long-term debt, and they don't anymore. So negative 814% though is kind of insane. I'm probably just going to do the zero credit there because they have negative equity and they have a massive amount of long-term debt, which again has been coming down, which isn't too bad. So overall though, pretty decent score, 68%. Let's put that in the table, 68%. And so for Dell, oh no, I did it. Okay. Dell, honestly, slightly above average for them. Actually, not really. I think the average is right around mid 70s or so, but not too bad. I mean, they beat Dollar General, which not terrible. So let's go into their earnings reports now. So this is their quarter 2. So we saw revenue beat on infrastructure solutions, slight miss on the whole client part, and it looks like a slight miss on their other section. Gross margin missed, operating margin beat though, which is pretty solid. And then it looks like operating margin for their segments beat and was mostly in line, a little bit of a miss. So overall, kind of a mixed report. I mean, they did beat on revenue in their biggest segment, which is good, but not anything too spectacular. And then for their next earnings report, they have a lot of information here. So 24 billion in revenue. If we want to compare that to their income statement, I believe if we go to their quarters really quick, we can see their last one was 25 billion. Again, you also have to take into account the seasonality of their quarters, but let's see. It does not say the total here, but I'm sure. Oh, sorry. I was just looking at it, 25 billion. So a little bit of a decrease on revenue there. Gross margin 22.5% looks solid. Operating margin 8.8. And then this is for quarter 3. This is, I believe, estimates for quarter 4. Looks solid there. So revenue for 2025 estimates 95 to 98 billion. So let's go back to the years here and see if that's in line. So 95 to 98 is a very significant increase from the 88 billion, 91 billion that we're seeing this year. So that is honestly really good to see for that. EPS looks solid. Price history for quarter 3. They usually have a very good quarter 3 apparently. So that is something to think about with Dell. But saying that, let's go into their chart and see what the chart is looking like. So looks like they've actually had very solid growth in their stock chart recently, especially. But overall, I think their next earnings report will probably be fairly positive. I can't imagine demand slowing down too much for them. But overall, I think we'll continue to see this trend. Depending on how good the earnings report is, tomorrow we might see it start hitting some new highs in a few weeks, in a month or so. So make sure to look out for that. But overall, I think that is it for Dell. Make sure to subscribe if you haven't. I hope you enjoyed, hope you learned something, and I will see you next time.